everybody. We have a new look here for the Stock Showdown podcast. I've done some podcasts here from room 213. The layout's a little bit different. So it's a wide-angled lens, so I had to bring the lens a little bit closer. We don't need to see the entire classroom. I guess you just need to see me, the American flag, and some whatever's in the background. But nevertheless, I also want to, again, draw attention to our wonderful guest here this morning. That would be Brighton Gbarazia. We, again, welcome him to the Stock Showdown podcast. The goal of this particular podcast is to interview entrepreneurs of all walks of life and kind of get their backstory on how they came to be. This is a great educational resource for anybody, but particularly my students. And that's kind of what I geared my podcast to when I went on my paternity leave, is I wasn't there on the day-to-day with my students, and I wanted to give them some sort of substance in my absence. So I would interview entrepreneurs, again, of all walks of life to get their story and, of course, their advice to high schoolers growing up in this day and age. So let's get right into it. Thank you again, Brighton, for joining us on the Stock Showdown podcast here this morning. We'll just dive right into it. Brighton, give us your backstory. Give us your how you came to be in the industry that you're in, which is the mortgage industry. It's a very hot topic, and it has been for specifically the last couple of years, which we're going to get into. Why don't you tell us a little bit about yourself, Brighton?
Thanks, William. Yeah, thank you for having me on your podcast. Great work that you're doing, by the way. This is awesome, helping the young generation learn this stuff, because some of this stuff I wish I learned when I was in high school too, a little bit more. Yeah, a little bit about me. My name is Brighton Gbarazia. I'm originally from Nigeria, but I immigrated to Canada. So for the last decade or plus here, I've been working in the financial industry, mostly in roles of mortgage underwriter, auto underwriter. I've pretty much done any kind of underwriting you can think for the banks. And also I was working as a financial advisor as well. So that's been my background, kind of just learning all the insights. This year, you were talking about entrepreneurship. I decided to kind of make the move into that entrepreneurship. I figured it was better for me long-term to kind of try to build something on my own. And I really wanted to help people understand finance, not in the sense of how the bank sells finance, but just down-to-earth, simple advice that actually helps you create wealth. Just to help you to be able to have more control of your time. So I started a company called Wealth Marathon. And then I wrote this book, Master Your Mortgage, which basically dives into items that the banks don't want you to know about your mortgages, in hope of helping people better understand their mortgages and also work their way towards financial freedom.
So I'm actually just looking up your company right now, Wealth Marathon. So everybody at home, again, want to check them out. That would be, I'm trying to look through the website, My Marathon Wealth. Is that you?
Yeah, Wealth Marathon. That's right.
Marathon Wealth. Okay. So we got it up here right now. So looks good.
Wealth Marathon.
Wealth Marathon. I'm sorry. So
yeah.
wealthmarathon.com?
That's right.
Wealthmarathon.com. So you got me curious now. You said you started this because you wanted to educate people on what the banks don't want you to know about your mortgage. So let's get right into it. When people hear mortgage, again, they think it's safe, it's reliable, trustworthy product. Everybody pays their mortgage, et cetera, et cetera. What do the banks not want you to know? The behind-the-scenes stuff about your mortgage. Now, you were a mortgage underwriter, so you saw the behind-the-scenes stuff.
That's right. I think when the big thing I would say that I want to get across to people was it's so critical that you spend the time to understand what mortgage debt you're comfortable with. And the reason for that is when the banks underwrite your mortgage, they're in the business of risk underwriting. What that means is it's possible for us to approve a loan if it is not necessarily financially right for you individually, but we have mechanism behind the scenes that we can offset our loss. So for example, there's even in the US, there's insured mortgages and uninsured mortgages. So in Canada, you can get an insured mortgage basically means a lender is made whole even when you default on the loan. So it's possible for you to have a mortgage where maybe I'm looking at that application, I'm going, I don't think you're ready for this yet, but I have a way where I can insure that mortgage and then I can make it ensure that my bank doesn't lose any money on that loan. That may put you in a tough position, but again, I've approved the loan because I've covered myself, the bank, for making sure that I don't lose money on that loan. The other big picture I just want to tell people is like, no matter where you are, whether in US or Canada, banks approve your mortgages based on your gross income, yet they expect you to make mortgage payment based on your after-tax income. To me, that just seems a complete disconnect, because that means everyone, if they don't spend the time to think about what the right mortgage loan is, debt, by that I mean you've spent the time to figure your budget in, all the expenses that go into being a homeowner, and you just take what the bank gives you for an approval, you've basically been overextended on day one, because none of us live on our gross income. All of us have to pay taxes. So the money we get back is what we use to pay our mortgages. So it's really one of those big pictures I try to come across in the book, letting people know you're being approved on your gross income, but yet they expect you to make payments on your net after-tax income. That just seems bizarre to me. Why wouldn't you approve the person based on what we know they take home? That way we know the amount we've given them is actually what they can afford. So that's the big pictures. And I drill a little bit into it, but that's the big things I just want people to kind of know about their mortgages.
That blows my mind. That we, and it's across the board that we do this, that we are approving people based off of gross and not net. Is that across the board? Is that an industry standard?
Yeah, and again, I don't. That's totally true, because you got to think from the bank standpoint. Like it's a lot more in work and to figure out each individual's net income, because all of us is different positions. Some people could have self-employed income, they could be working with a company. So I think the banks just figured this was a good, simple way, and it is, because you just find what's your gross income. Most people know that, right? Most people don't know their net income. You know, they have to figure out, okay, this month it could be 3,000, maybe next month it's 4,000. And that makes the deal really time consuming. So the banks figure, let's take the gross income. And again, that's not really a problem if the individual spends the time to understand what's going through all the costs and figure out how much they can actually afford in mortgage debt. The trouble is most people don't do that. Most people assume the bank is doing that work. Most people assume the loan they get is what they can be approved for. Like if I get a $300,000 loan, the assumption by most people is that the bank has done that due diligence and I can afford that $300,000 loan. But that's not necessarily true. And even I go into some of the information they take into your debt, it's not everything we consider. So for example, when we're approving your loans on the mortgage side, and this is specific to Canada, and also I believe this is the US, we take into there's two ratios the banks look into. They're called gross debt servicing and total debt servicing. And they usually have a specific ratio you have to meet. But I try to point out in my book, even the debts the bank take into consideration doesn't make sense, because in Canada, if you have like a strata, which is like a condo or something like where you have strata payments, in Canada, the bank will only take 50% of that. Yet most of us have to pay 100% of that back. So why would we only take 50% when we know the individual has to pay 100% of that cost? So it's just little nuances like that where it doesn't really make sense. It makes sense from a lender standpoint. I understand why they do it, but from an individual standpoint, it makes no sense.
So this is being done in a way to enhance the leverage that banks can take to make more loans or increase the size of said loans to ultimately make more money on these loans. Do I have that about correct?
Absolutely, William. You've nailed on the head. It's just again, from their business standpoint, it makes total sense. We can give you as much loan as possible to increase the amount of interest income we can generate off that.
So then it is absolutely imperative that an individual does their own due diligence and sits down, because if they sit down with the mortgage banking representative at the bank, they're not going to give them this education. They're in the business to make this loan and make it at the highest possible level they can. They need either A, their own education, which I got to believe this is why you wrote the book, or B, some sort of financial advisor that gives them this advice, because the schools aren't going to do it.
Yeah, you're absolutely right, William. It's really imperative that you spend the time. And one of the reasons, and again, if you've been a homeowner, you know this process is extremely emotional.
Yeah.
our home is so much more than just an investment. That's why I try in the book is you need some time and space to try to give your rational self an opportunity to step in, to have a fighting chance against your emotional self when this process gets going. So this book is designed to help you do that, hopefully, where you can just get that information that the banks are not going to give you. So you're a little bit more informed, and the knowledge gap between you and the bank is more even when you go in there and you understand, okay, that's what you're doing for your business, but I have to look after my own family's finance. And this is what I think is a comfortable mortgage loan for us to be able to live the lifestyle we want to live and not become mortgage poor.
And, to go back to a point that you made with the different ratios, the debt service ratio, or, I think I heard where I used to work in a bank, we called it the debt to income ratio. In a sense, it's the same thing. Yeah, it's taking the debt that's on your credit report that shows up. But how about again, does this fit into my budget? Because there's plenty of expenses I have to pay that isn't classified as debt, but my electric bill that comes out every month, and gas and food and all that stuff that is going up at 8.5% year over year due to inflation. You have to understand what fits into this budget, but that's not the banker's responsibility to tell you that, right?
Absolutely, William. You're singing my music here because you're absolutely 100% right. It's those things that they don't tell you about. And that's why, especially if you're a first-time home buyer, it's a shock when you find out, oh, wait a minute, like I don't have enough room here. Like I have these other debts that I have to take care of. So you're absolutely right. Like, why isn't all those expenses? Like, for example, we don't take into consideration property insurance into that calculation for GDS and TDS. And I'm going, but the person has to get the insurance in the home. You force them to get the insurance in the home. Why wouldn't you put that into their mortgage payment to make sure that they can afford that? So it's just little weird things that you find out. And I break that down in terms of what exactly they put into your ratio. So you know that. And like you just said, William, there's expenses that go up every year. There's maintenance. I have to pay property insurance, all those different things, but they only capture what they want to capture that's convenient to them. And the other stuff, they don't capture it. They leave it up to you to just figure that out. Because again, to we said earlier, if they do capture those things, the loan amount would be lower for you. By default, that means that they're setting out lower mortgage amounts, lower interest payments, lower income. So it's just, you have to really spend the time with someone or yourself and learn this information. That way you can tell the bank, that's great, you gave me $300,000 loan, but actually 200 is the best for me, right? That's what I want to take.
I mean, we're setting ourselves up, it seems like failure, that we're giving these people these loans that they can't afford to pay back only because we're trying to make as much money as possible, let alone, again, what's happening right now with again, the mortgage market right now. And you're in Canada, you said?
That's right.
I mean, I don't know how the mortgage market is in Canada, but it's out of control here in the United States, where you've got people outbidding each other, cash offers. I mean, the average price of a piece of real estate is going up like whatever, $100,000 on average on the median household income, median piece of real estate, like $100,000 over the last 2 years. I mean, you're pricing so many people out of the market. How are these people still being able to get afforded for a mortgage? Or is it a lot of cash buyers that are coming in that don't need a mortgage? Have you been seeing any of that?
Yeah, I think we mirror the same thing as the US. And I think this is more of a global story too, because yeah, it's sort of crazy where we've put ourselves in, but this is a little outside. This is not a podcast maybe potentially, but I know the Fed has kind of made this situation worse in terms of, but I understand why they're doing it. It's getting to a point where I think the average person is starting to realize how ridiculous this is. We have the same problem in Canada. If you're a young home buyer trying to start out, it's impossible. You're not getting in because you're getting outbid. The prices have gone way over everyone's budget. Our incomes have not kept up to these prices. And typically what I find is happening now, particularly if it's a young buyer, they're going to mom and dad quite often because they usually have the equity and then they're gifting them those down payments. But if you're just trying to start off from a young person, go to university, get a good job, that process is so much more difficult today, or impossible, really. And I try to point out to people, I said, like, we may have a problem here, because if we don't have a process where people who have good jobs in our society cannot buy a home on their own, we've got a problem. Some people may be benefiting right now, but long term, this is a problem for our society. It's not a good thing. And we need to find a way to bring it so people can get into the system, that they're not over leveraged. They can still have a life, raise a family, do all the things that we think are important, and not just simply buying a home because they think it's a good investment long term, but they don't understand the fundamentals, what's happening in the big picture here. It's not good. In Canada, it's not good, but I understand why it keeps going up, but I try to educate people and tell them, take yourself out of the equation. Just look at the system. It's not a good system we've developed here.
Yeah, it really has me concerned, Brighton. Now, I've had a piece of real estate and owned my home, and I've been in that home for now almost 4 years now. So I have reaped the benefits of the appreciation, which is fine. But I am seeing, obviously, I'm not immune to the inflation of food and gas and everything else and all the other expenses that go up around me. But I feel like we're making these loans, and let's go back to that. We're making these loans to people that are stretched as it is, and this is only stretching them even further, to the point where if the average person does want to get a home, they can't afford the interest rate on a general conforming 30-year fixed mortgage. And so the only way that it fits into their budget, and I was reading this article the other day, we were speaking a little more candidly before we went on air, that the adjustable rate mortgages and the volumes from adjustable rate mortgages has gone up at the fastest pace since 2009, because those are the rates that people can now afford to get into. My concern is that what happens in 2 years from now, when that adjustable rate now starts to adjust based on market conditions, and those market conditions aren't favorable, and now your interest rate goes up, and does now your payment. Are you seeing any of that too, or can you speak to any of that?
Yeah, I think that's always an important point to keep in mind when you get a variable rate. I would say variable is not really a good product if you're someone who has an affordable issue, because a variable rate is really for an individual who has the capacity to handle what I call fluctuating payments, because that's what they're signing up for, and then has a better idea in terms of like what's happening in the market and where we're going. Like you guys, we had a 50 base increase from our federal Bank of Canada, and again, they're expecting to another 50 base increase. So they're being pretty aggressive in terms of trying to contain this inflation problem. But again, if you're doing a variable, my clients, I try to really figure out the position. But if my client has an affordable issue, we really need to find a payment that can work, because it means they're already stretched as it is. And if things change on us, which no one knows the future, they can't afford to have things change because they're really just tight. So it's better for us to figure out a product or a solution where we can get you on the budget and keep something consistent for you for the next several years, then put you in a product that's really designed for an individual who has capacity. They can handle that increase. And we're trying to take advantage to see if we can save some interest, because we do have some capacity room, and affordability is not really the concern. It's just more, can we save a little bit more, because we can handle our payment going up an extra $500 if it had to go up that way. Whereas you don't want to be in that position if you're someone who's a first-time home buyer. Is not really a good solution, because they're usually just making it in, so they can't afford their payments to go up. But again, it's individualized. You just need to speak to someone, really figure out your scenario. But much like you guys in the US, we're seeing the exact same thing. Everyone's got into the variable product because it was super low, and now everyone's concerned because they're going super high. So, I've gotten lots of calls from people who want to talk to me about that. But again, when I'm setting up clients, it's just, you got to figure out your position, your individual situation, and try to make a decision that's best for you. No one knows the future. Like, no one, not including me. I don't know what's going to happen with the feds 3 years from now. But we can figure out what's likely to be consistent for your individual situation and plan around that.
But piece of education and philosophy there. So, I see Erie eerie similarities to what's happening now as to what was happening in the mid 2000s. And I say that because I came from the mortgage industry. My first job out of school was for a mortgage company. And then I started working for Wachovia Bank, which ceases to exist because it was making some very poor financial decisions regarding mortgages back in 2007. And then went belly up in 2008, was taken over by Wells Fargo. But nevertheless, I'm starting to see eerie similarities to what took place then as to what's happening right now. The only difference, and maybe you can speak to this, is I don't know the behind the scenes. It seems like we have better financial lending practices in place where we're not just giving out loans to people with a pulse, that we are doing some sort of due diligence as far as credit scores are concerned and income documentation. Now, this obviously goes against what you were saying earlier with we're qualifying people off of their gross and not their net and all these different factors that we're not considering, which that concerns me. But it seems like we are making more ethical decisions of who we're loaning money to. But my concern is the rapid appreciation with the interest rates, people becoming too stretched. Do you see a slowdown in housing as far as prices start to recede, where people who are buying now might end up in over their head or underwater on their mortgage, combined with the fact that they start to see their payments rise? Do you see anything like that festering in your eyes, Brighton?
Yeah, it's tough. I mean, I've been saying, and I always preface when people ask me about questions, I've been saying I think the housing market, and particularly in Canada, has been unsustainable for a long time. But yet, here we are. It's never gone down. It just keeps going up, it seems like. So I've kind of given up on that. What I will tell people is like, I try to look at things from a system standpoint. And what I see is I don't think this is sustainable, because I think what we're creating is we're creating a group of individuals. And again, I'm a homeowner, just everyone's listening to. I'm in this category where it seems to be that once you get the property, because it's so exclusive to be able to get in, by default, we're creating two separate individuals in our society, those who happen to have assets already and those who don't have assets. So if we go back to COVID, what the Fed did was basically make that problem worse, because a lot of the individuals who benefited during those policies was because their policy effectively raised asset prices, which is what you're talking about there, Willem. That their dramatic increase in asset prices, home prices, was clearly a result of the Feds. Like, you can spin it however way you want, but any kind of economic doctrine tells you that when everything's shut down, we should have fire sales, because there should be individuals in the purely capitalist system that have been over their head, and we would come in and entrepreneurs would come in and they would buy those assets and they would make it better. But the Fed stopped the building, which was good for all of us because we didn't want to be in that situation. But like with anything, there's always side effects. And the side effect was increase in inflation. And now they're trying to tame it. So I think if we look at housing, what I try to look is like, if I have a police officer or a teacher who gets in the what we call our prime jobs in our society, can they afford the house on their own? Is their income levels enough for them to be able to afford those homes? And no matter where you look around the world, the answer is no, right? So what I see is a system where if you have the assets, people are buying the assets because we've decoupled the income, which is what keeps housing prices leveled and stable. We've decoupled that process by making sure that people can now buy a home, not based on their income, but more based on the capital appreciation they've been able to acquire in their homes. And that's what they use to put down to bring that mortgage down to a level where their income can actually afford it. So it's kind of a weird engineering thing we're doing, but in effect, what that means for young buyers, the only asset they have is their income. So of course they can't get in, right? So long term, I think that's a problem. We may be creating a society where we have those who have assets and those who don't. And that creates a whole nother side topic that we don't need to get into. But I think long term, we all have to start asking ourselves as a society, what is this asset for? I try to tell people, I think it's become more like a stock. So that's the way I view it. I don't think this is a place where people, raise their family. It's really just an asset, another asset class for most people. And that's the way I tend to look at it from my side, including me as a homeowner. I realize, it's just an asset class like stocks. It's not a home anymore in that sense.
Yeah, I think you said it very, very eloquently at the very beginning that you have to remove the emotional attachment from this whole process, or else again you're gonna be in tears. There's gonna be a lot of heartache, pain, whatever you want to call it. But this is again, for all intents and purposes, the largest purchase that one is going to make in their lifetime. So I see that it is a very, again, emotionally tied thing. So I think you've given some valuable insight, and I'm short on time, Brighton, as I am between classes right now, and I do have a class
That's okay.
coming in. But this was fantastic. I'd love to have you back on the show. I love talking the mortgage industry. I think obviously over the last 2 years, it has really grown in popularity, and it poses some serious concerns that are going on, which you've just detailed over the last half hour or so. And in your book, and everybody that's listening, check it out. It's on the wealthmarathon.com website. Master Your Mortgage, What the Bank Won't Tell You About Buying the Right Home. And go back through this podcast and listen to the last 30 minutes about very important things that you as a homeowner owe it to yourself to do your own due diligence, because the bank is not always going to do it for you because they have profits in mind, not necessarily your best interest in mind. So you have to be cognizant of that. Any final parting words, Brighton, for the Stock Showdown audience?
No, I just want to thank everyone. And William, thank you for having me on. It's been a pleasure. And absolutely, if you want me on again, I absolutely love to come on. Yeah, just everyone read the book. It's just giving you some information to really arm yourself to reduce that knowledge gap. So hopefully you find some value in it. And again, William, thanks for having me on.
Thank you very much for being a guest there, Brighton. As soon as this goes live, I'll send you an email. And again, God bless, and thank you for your insight, Brighton.
Thanks, William. Okay, you take care.
Take care.
Bye-bye.